Next up, we've got Gina. She's one of WA's top SMSF strategists and has also recently been approved as an Australian Financial Services Authorised Representative. So a round of applause for Gina for that, because that took quite a lot of work. As such, our SMSF department is literally growing daily. Her knowledge about all things to do with super is second to none, and her strategies have helped so many of our clients. So please welcome Gina.
Thanks very much for the introduction, Debbie. Good evening, everybody. I'm so pleased to see so many of you here tonight, despite the rain being forecast. That's fabulous. Let's see if we can make this work. There we go. Now, you've already heard this disclaimer a couple of times this evening. Let me say as well that my presentation is just for educational and general information purposes. It is not intended to be personal, financial, or legal advice. And if you want to act on anything that you hear tonight, then please get personal advice from a qualified professional such as myself. I'm not sure if this mic is working. Okay, so I'm tonight going to talk mainly about the budget proposals. There were a great many proposals affecting superannuation. At this stage, it's important to know that they're all just proposals. For them to actually become law, we need to have three things that need to happen. The first one is that the current coalition needs to get elected on the 2nd of July. The second is that they then need to draft legislation, and that needs to be passed through Parliament. And the third thing is that it then needs to also pass through the Senate. Until all of these things happen, all of the proposals are just that. They are proposals, and they can be changed. It's also important to know that all of these proposals, if they become law, would affect all superannuation funds. So not just you here who may have a self-managed super fund, but also if you have an industry fund, or you have a retail fund, or perhaps you have adult children who are in an industry or retail fund, all of these proposals will affect all super funds, not just SMSFs. I'm also just briefly later on going to take a small detour from the budget, because in April, almost unnoticed, there was a small change made by the ATO in their interpretation of existing legislation, and that may affect some of you here tonight. And then finally, I'm going to say, where do we go from here? So at the moment, we have a concessional contribution limit of $35,000 per person per year, if you are 50 years or over, or you've just turned 50 in the current tax year. If you're younger, then your limit is $30,000 per year. Now the proposal is to reduce that to $25,000 per person per year. The impact of that would be negative on our super fund balances, because naturally we're putting less money into super, so we're going to end up with less money. It'll also increase for a great many people their personal income tax. And that's at the moment, if you contribute, have your employer contributions, and you have your salary sacrifice contributions up to $35,000, you pay less income tax. If these proposals come in and we are reducing this to $25,000, you'll be paying more income tax and you have less money in super. This is not a good idea. A more positive proposal is that we might be allowed to make catch-up contributions. So if you haven't used your 25,000 proposed new limit for every year, then you might be able to do a catch-up for up to 5 years. Because you don't know yet whether that means the current year plus 4 years, or whether it's just 4 years. So here's an example in this slide for Mary, who in the first year contributes $10,000, in the second year $11,000, and in the third year she would be able to make catch-up contributions of up to $54,000. That's because 3 years at $25,000 gives you $75,000, and those three numbers do add up to 75,000. Now that's a nice concept in theory, but in reality there's one catch. Because first of all, you need to have sufficient taxable income to actually be able to make additional concessional contributions. If your taxable income is too low, then the catch-up contribution rule is not going to help you. In this example, I've got Mary and her husband, each earning $75,000. So as a family, they've got $150,000 a year before tax for themselves and their 2 children. If Mary makes her catch-up contributions, then their after-tax income for that particular year will be just $83,000. Now that might be possible for 1 year. If the kids go to public school, if they don't have a holiday that year, it might be possible for Mary to do these catch-up contributions. But in reality, very few people can actually afford to make additional contributions over those made by their employers until they get to their 50s and until the kids have left home. Until then, most families can't actually make additional super contributions. But it could still be useful for people who have got variable income levels. Maybe they get a salary plus bonuses. 1 year the bonuses are up, 1 year they are down. So those catch-up contributions might then come in helpful. And as you will see on the next slide, it can be helpful in future if you had a large capital gain from personal investment income in a particular year. Then you might also be able to use those catch-up contributions. But also remember, you can only make those catch-up contributions if your super fund balance is no more than $500,000. So there's another limitation on this proposal. But this could be positive for some people. So at the moment, personal concessional contributions can only be made by people who are either self-employed or have employment income that is less than 10% of their total taxable income. So the proposal is to do away with that restriction so that in future all taxpayers can make personal taxable super contributions, tax-deductible super contributions. But again, remember, you'll be hampered by that $25,000 total limit for concessional contributions, which will then include your employer contributions, your salary sacrifice contributions, and whatever personal tax-deductible contributions you want to make, perhaps because you had a large capital gain from one of your investments. You can't go over that $25,000 limit. At the moment, if you are aged between 65 and 75 years old, you can't contribute to your super fund unless you pass a work test. So the proposal is to do away with that work test, and those over age of 65 can contribute to super whether they're working or not. So again, this is a small positive step for people who have taxable income outside of super, or perhaps they have investments still outside of super, or they make an inheritance and they want to transfer that in as a non-concessional contribution. At the moment, the reality is there's probably not a lot of people who are over age 65 not working and have taxable income outside of super. But in future, if the contribution restrictions do become law, then that particular group of people might grow, and so this could have a positive impact on them. This particular proposal doesn't really affect superannuation as such, but it affects personal income tax. So if you're currently classed as a high income earner, that means you have income of more than $300,000 a year, you pay already an extra 15% tax on your super contributions. So the proposal is to drop that limit down from $300,000 to $250,000 and make you pay that extra 15%. That doesn't necessarily affect your super fund balance unless you pay that extra tax from the super fund balance. It is really more an increase in your personal income tax. Now we're coming to some of the more meatier proposals in the budget. This is the transition to retirement income stream, which is a bit of a mouthful, and so we just call that a TRIS. At the moment, depending on your date of birth, you can start a TRIS from age 55 onwards, and then you don't pay any investment income, no tax on the investment income in your pension account. So the way that works, I drew a little diagram there. You have your accumulation account, and let's say at age 55 you've got $500,000 in there. Then we set up your TRIS. We just move that $500,000 from the accumulation account across into the pension account. Now you pay no longer any tax on any investment income that is made from this pension account. If there's a capital gain as well, there's no tax to pay. In the meantime, you still have your accumulation account here because you still carry on working. There will still be employer contributions coming in. Perhaps you still do salary sacrifice contributions. Perhaps you do non-concessional contributions. All of that will continue to go into the accumulation account. And on that side, on the investment income that relates to those contributions, you carry on paying 15% tax. But on the other side, where you've got your pension account with that starting balance of perhaps $500,000, all the investment income currently is tax-free, no tax to pay. The proposal is, as you can see there, to just do away with this altogether. So if this becomes law, then from the 1st of July 2017, if you have a TRIS, you'll be paying tax again, 15%, same as in the accumulation account. So except for certain exceptional circumstances, the TRIS will basically be dead, because there's now no point really, because you pay 15% tax anyway in the accumulation account, might as well leave it there. This is a particularly negative impact, has a particularly negative impact on the super balances, because potentially from age 55 to 65, you've now got 10 years where you've got to pay tax on the investment income in your super fund, and previously you had to pay no tax. So this is a really big change and will have a big negative effect on the super fund balances that will be left for you when we get to retirement. Now, we don't know yet whether this will also have an impact on TRISs that have been set up before the 1st of July 2017, but my guess is that yes, it will apply to all. At the moment, when you start your pension account eventually, either because you have fully retired or because you turned age 65, whichever happens before, you then pay no tax on the investment income in your pension account. The proposal is to limit the starting balance of your pension account to 1.6 million per person. So that means you pay no tax on the investment income that relates to this pension of 1.6 million. But if you have more, then that needs to stay in the accumulation account and you pay tax at 15% on that. So because this is a little complicated, I've got 3 examples here. Our first one is John, and this is the current situation. So at the moment, up to age 60, John has his accumulation account and contributions come in there and investment income comes in there, dividends, interest, rent if you have a property, and he pays tax on this at 15%. Then at age 60, for John, we set up a TRIS. So as I said before, we move everything from the accumulation account into the pension account. No tax on the investment. Oops, what have I done? No tax on the investment income in the pension. And on the accumulation account, there's 15% on everything as we go forward. Then eventually John retires fully, as I said, either because he finishes work or he turns 65. Now he doesn't have an accumulation account anymore, everything has been moved to pension, and there's no tax to pay. So this is the situation at the moment. Once you're in pension mode in your super fund, no tax to pay. This is the future for Max if the new proposals become law. So Max doesn't retire until age 65. So he has his accumulation account, pays tax at 15%. Just before retirement, in his accumulation account, he has a balance of $2 million. Under the new rules, he's only allowed to start a pension account with 1.6 million and then pay no tax. And the other $400,000, the balance, needs to stay in the accumulation account and pay tax at 15%. This would be the future for Bob, who's got a slightly different scenario. Bob has a starting balance at age 65 of just 1.4 million, not the total cap of 1.6. So he starts his pension with that, and he has 0 left in his accumulation account. Because he hasn't used all of the cap, he's only used 87.5% of the cap. So we'll just remember that he's got 12.5% left, perhaps for later. We'll see. Now, Bob, for some reason, wants to carry on working, so he does that for the next 10 years. He loves his job. And so he continues to accumulate contributions in his accumulation account. Employer contributions, maybe the salary sacrifice, maybe non-concessional contribution. It all comes into the accumulation account. Then when Bob gets to age 75, he's got $300,000 in his accumulation account, and originally he started his pension with 1.4 million. We don't know what it's worth now after 10 years. That doesn't matter. Now, in the 10 years from age 65 to 75, the cap has been indexed. It was 1.6 when Bob retired. It is now 1.8. And remember, Bob had 12.5% left of the cap when he originally started his pension, because he only had 1.4 million when he started off. So now, from his accumulation account, he can use that extra 12.5%, which comes to 225,000. So he can start a second pension, which will also have tax-free income going forward. And then in his accumulation account, it's just the balance left of 75,000. That's got to stay in there. It'll still accumulate investment income, dividends, rent, interest, whatever, but that now has to pay tax at 15%. And the final one is Tom. Tom retired a while ago. He's now 68. And when he retired, he has currently a pension balance of 1.8 million. Or if I say currently, I mean on the 30th of June 2017. So if the new changes become law, then the next day, on the 1st of July 2017, he would be obliged to roll $200,000 out of his pension, because he's only allowed to start off with 1.6. 200,000 come out, and they go into the accumulation account, where he then pays tax at 15% on all of the investment income. So those are roughly the three scenarios of how the future would look like if this particular proposal becomes law. Now, what's quite important to note is that even under these future proposals, you would still be better off having your income-producing assets in the superannuation environment. And that's because you'll still only pay 0% tax on the investment income of the assets up to 1.6 million, the investment income that's associated with that balance. And over and above that, you still pay 15% tax. Personal income tax rates, on the other hand, start at 19%, and they go up all the way to 45%, plus you've got to pay 2% Medicare on top as a minimum. So you might be paying between 21% and 47% tax, whereas within the super environment, you still only pay 0% tax or perhaps 15% if you have more than 1.6 million. So superannuation is still the best place if you want to have more money in your retirement, because you pay less tax overall, even with all of these proposals. We also still have all the strategies at our disposal. As Trevor was talking about, we can buy property in the self-managed super fund. This can be residential property, it can be commercial property. Some of you might be running your own businesses and you might be owning your business property. We can still transfer that into the super fund, where you then get a tax deduction in your business for paying rent to yourself, because your super fund is now your landlord. And that money in the super fund, you only pay 15% tax or perhaps 0 tax in retirement if you have less than 1.6 million. So all of those strategies are still available to us. Now, I've kept this one to last because, in my personal opinion, that's actually the worst of all of the changes, and that they propose to put a lifetime cap of $500,000 on non-concessional contributions. So this is your after-tax money. So any savings you have, any shares you own in your personal names that you want to transfer into the super fund. If you emigrated to Australia from the UK and you brought with you your UK super money, or you're thinking of doing this now, you will be limited to just 500,000. Now, if you tell a 20-year-old that they can have 500,000, it probably sounds like a really large number to them, but it really isn't over the whole lifespan of when we contribute to our super fund. And then we want to live off this for the next 30 years until we die aged 85 or 90 under the new statistical figures. So this will result in much lower super fund balances in the future. So this is an example that's been prepared by Curium, who are a firm of actuaries. That means they're professional number crunchers. And this particular lot just crunches numbers for superannuation. They don't work for insurance companies or anybody else. They're just specialized in superannuation. So they've sort of worked backwards and said, right, you know, if we can have 1.6 million in super and not pay tax, how would we get there? And so they've said, we need someone who at age 25 has a starting salary of $70,000. This lucky person is going to have a pay rise every year of at least 3.5%. And their super that is invested, their contributions, attract an investment return every year of 7%. Now, they just make the normal employer 9.5% contribution until they get to age 55, when we hope that their children have left home. And then they can afford to put in a bit of extra, so they do their maximum 25,000. If all of these things line up, oh yes, and inflation averages 2.5% per year. So if all of this lines up perfectly, then this person in today's money at age 65 will have $1.1 million in their super fund, and then they can still put in their 500,000 when at retirement perhaps they downsize, they sell the home and they realize some equity and they put the 500,000 in there. So then they can end up with their 1.6 million in super, and if that generates them a cash income of 5% per year, then they'll have $80,000 a year to live on tax-free. How likely do you think it's going to be that all of this is going to line up just like that? Now personally I think probably not very likely. So again, if all of these proposals take effect and become law, you'll probably end up with much lower super fund balances. Now I want to take a little detour from the budget, and I'll come back to it after that slide. Just in case, I know there are people here tonight, great many people who are not Sondergaard clients, and you might not have heard of this. It might affect you if you have a self-managed super fund. The ATO in April, just before the budget, changed their mind on their interpretation of existing legislation. According to the legislation, and that has not changed, the legislation stays exactly the same, super funds can borrow, as Trevor said as well, provided we set up what's called a limited recourse borrowing arrangement. Now that's quite easy to do, not a problem. And then the super fund can borrow to cover the purchase cost of whatever asset it is it's buying, plus any associated costs. Now the best example to explain that, and that's why I've used that here, is if we buy a property. Because we all know when we buy a property, there's of course the purchase cost, then we usually have stamp duty, we have valuation fees, there is bank fees, application fees, and so on. So what the legislation says is we can borrow for all of that. We can borrow 100% of the purchase price and for all the associated costs. In reality, it looks a bit different. Now we've got Westpac here tonight, and they will actually never lend you 100% of the purchase price and all the costs. They'll be laughing at you. They will only ever lend you 70% of the purchase price for a residential property or 65% for a commercial property. But what the legislation allows, and remember the legislation hasn't changed, is you could have a related party loan. So you could lend money to the super fund yourself, or if you were a younger person and you could go to the bank of mum and dad, they could lend money to your super fund. And then you could borrow 100% of the purchase price, all the costs and so on. Or if you went to the bank and they gave you 70%, you could lend your super fund the rest, the other 30% plus costs. And the legislation has not changed. What the ATO then also said, on the related party loan, when you're lending the money to your super fund, the interest rate that your super fund has to pay can be anything between 0, meaning no interest rate at all, or whatever currently the commercial rate is, if you can provide some evidence as to how you arrived at that commercial rate. So anything from 0 to whatever it is. And as I said, remember the legislation hasn't changed. Now the ATO always say that they don't make tax law, but they interpret it. And if you don't like their interpretation, you can go and see them in court. Now I'm sure the majority of people here haven't actually got the money to see the ATO in court, so the reality is, whatever interpretation the ATO come up with, we generally have to live with. And so this is what they decided in April. Now, as I said, this is only a small detour from the budget presentation, so I haven't put up all the details on this slide. But now, the interest rate, the length of the loan, the maximum permitted LVR, the security required, and the nature and frequency of the repayments are all fixed in a new ATO interpretation on how the rules have got to work. You can operate, and remember this only applies to related party loans. So it only applies if you are lending money to the super fund. It does not imply if the super fund borrows from the bank. You can still borrow from the bank as much as they want to give you, and you pay what interest rates they tell you to pay. So it doesn't affect bank borrowing, only if you borrow from yourself. If you don't follow those, oh yes, then they said you would have to comply with the new rules by 30th of June. So they put this out in April and gave us 2 months to make sure that we all comply. So naturally there was a bit of an outcry, more like an uproar. So they've since then changed their mind and they've given us till 31st of January 2017. The consequence of not complying with those new interpretations are, you don't have to follow that. You can do what you did before and have let's say an interest rate of 3.5% or whatever you charged. And if you do that, then the ATO say, fine, you can do that, but then we're going to tax you on the investment income from that particular asset, whether that's a property or whether it's dividend income from shares. We tax you at 47%. So not 0%, not 15%, like everything else, 47%. So if you're a Sondergaard client, then obviously we'll take care of that for you and make sure that everything is fixed up. If you're not a Sondergaard client and you have a related party loan in your self-managed super fund, make sure that you speak to a specialist SMSF advisor as soon as possible to make sure you can get everything sorted out before that nasty deadline approaches and you then get taxed at 47%. So this is the end of my little detour. I'm coming back to the budget now. And I just want to summarize the consequences of those budget proposals. So the first one, we had the 5-year catch-up rule. You know, if you don't use your 25,000 every year, you can catch up. That is a positive one, but only if you have sufficient taxable income. So if you're a mum who works part-time and you have our treasurer telling it'll be really beneficial for her, she can make catch-up contributions. Chances are she hasn't actually got enough taxable income to do that. The next one was the removal of the 10% rule, meaning that now everybody can also make personal tax-deductible contributions. That's also a small positive change. But remember, we'll be hampered by that overall limit, which is now much smaller, at $25,000 per person per year. Then we had the removal of the work test for the over 65s. Also a small positive change. If you have taxable income outside of super, you can now contribute, or if you inherit and you want to make a non-concessional contribution, then that's a positive change. Then we have the $25,000 cap now on concessional contributions. That's a really negative change. It will lead to smaller super fund balances and more income tax for a great many people. Then we had the $500,000 lifetime cap on non-concessional contributions. Again, will result in much lower super fund balances. And finally, the changes to the TRIS. Now we have to pay tax at 15% for an extra 10 years from 55 to 65 on our super fund balances. So naturally, if you're paying tax for an extra 10 years, you're going to have a lower super fund balance. And this was a particularly interesting statement. I just want to read that out in full. That's what the government said in the 2016 budget. The objective of superannuation is to provide income in retirement to substitute or supplement the age pension. So the objective is to substitute or supplement the age pension. That's a very interesting statement. Currently the age pension, I don't know if you can see that at the back, for a couple is just over $31,000 a year. $31,000 a year for a couple. Now I can guarantee you that's not going to be much fun to live on that if the new objective is that our superannuation balance is just meant to be enough to substitute the age pension. That's not going to be fun to live on. It's also crazy in another area, and Ian Christensen from Westpac, we spoke before the presentation started, and he put that very well, because he said we actually need retirees, or a certain sufficient large number of retirees who have incomes per year of 80,000 or 100,000 or more, because they can then spend money. They can actually go and change their car every few years, they can spend money on holidays, they can buy clothes, they can go to concerts, theatres, cinemas and so on, they can go to restaurants. Because we need people who spend money to actually keep the economy going. If our retirees just all live on $31,000 a year, they can't spend a lot. They can just about afford food and, you know, the rates and the electricity and so on, and that's going to be it. And as we heard from Andy's presentation from Bell Potter, the Chinese have realized you need to have a sufficiently large base of people in your economy that are consumers, that can spend money. And they want to increase that from 50 million to 100 million over the next 10 years. Because it's the consumers who create jobs. If you go out and we spend money, then that creates jobs. If we all try and live on $31,000 a year as a couple, we're not going to be going out and spending any money because we haven't got any. On top of that, the ASIC website MoneySmart doesn't really think we can live on $31,000 a year as a couple. They reckon to live modestly as a couple, you need to just have over $34,000 a year as a couple. And if you want to live comfortably, then as a couple, you need to have just under $60,000 a year. And by that they mean you can go on a little holiday every other year and you can run your own car. So again, not the big spenders. So this is a crazy idea, I think. So anybody who agrees, what can we do? Well, remember I said at the beginning, all of these budget proposals are just proposals. They haven't become law yet. So write to your MP, write to your senator, write to any MP you feel like, and tell them what you think about these proposals of capping your contributions at $25,000 a year, of having a lifetime limit on non-concessional contributions of $500,000, of taxing your tris for 10 years before you fully retire. Now, we will have some after the event communications with you, and we will let you know what that website address is, where you can look up the email addresses of your MPs and senators. And of course, you won't see that at the back, but there just is a list of the current government ministers and the current opposition ministers. You can write to all of them as well and let them know what you think. So in conclusion, it is important that we do take some action if we want to live comfortably in retirement and we don't want to see our retirement balances reduced, if we don't want to believe the objective is to just supplement or replace the current age pension of $31,000 for a couple. The other thing to remember is that even under the new proposals, superannuation is still the best place for all your income producing assets when you get to retirement age. And that's because you still will only pay either 0% if you have a super fund up to 1.6 million, or you may only pay 15% tax on the investment income. Whereas in your personal name, the tax rates go from 19 to 45% plus Medicare. So superannuation is still the best environment to have more money in your pocket at retirement. So if you want to discuss anything that you've heard here this evening with me, or you've got any questions, then please contact me. I will also be available as everybody else after the presentation, so you can try and nab me for a quick word. And thank you very much for listening.